Good afternoon and welcome. I'm Lou Miranda. I am the chair of the EAC for the Fordham's Real Estate Institute. I welcome everybody here today. We picked a really interesting topic. On behalf of Fordham Real Estate Institute, it's always a pleasure to volunteer as the EAC chair. And you're looking at what is known as our VCCL Visionary Series. This is the fifth series, a fifth session of the series. And it's just briefly stated, it's a 5-year mission that ties into the founding of the United States and the signing of the Declaration of Independence. And over the next 5 years, the mission is to have 2 or 3 of these events a year where we can contribute to the discussion of the real estate industry on issues that are cutting edge issues that will impact the business. And most importantly, what are the positive things that the real estate industry will provide to society in what I always like to say is that pursuit of continuing to form a more perfect union. Just a little bit of housekeeping before we start. We do have a chat room. We're going to ask the audience if they have any questions to go ahead and do those on the chat room. In the link to the chat room, you're going to find information about Fordham's offerings, including its 3 different masters in development, construction, investment, and management, and all its other certificate offering. I've been involved with the Institute for about 4 years now. It's absolutely terrific. It's done out of 3 beautiful campuses, one in Lincoln Center, one in Rose Hill, and up in Westchester. And we have just a tremendous staff, and our acceleration into this industry, into being a real provider of knowledge has been unbelievable to witness. It gives me a lot of pleasure to introduce Dan Mee. Dan, I don't want to scare you, but you and I are going on 40 years of being colleagues and good friends, and it's always been a pleasure to be around you, and I appreciate everything you've accomplished in your career. Dan is the president of Dillon Capital. Dan had a long run with Tremont, which he founded. He took it public. Prior to that, Dan was heavily involved, had a front row seat with the FDIC during the RTC savings and loan liquidation. And he was, I always worried about the developers that had to come up against Dan when their loans weren't due, but Dan brings great knowledge. He's a graduate of Harvard and Harvard Business School. And again, Dan, I'm going to turn it over to you. And thank you, everyone, for participating today. It's very much appreciated.
Thanks for the kind words, Lou, and good afternoon, everyone. I first became aware of blockchain technology really about 3 years ago. And I've been looking into its potential impact on commercial real estate and finance for more than a year now. Make no mistake, I am not a blockchain expert. I have spent over 30 years in capital markets, finance, and real estate, and I know that space very well, and I believe it positions me to ask some relevant questions this afternoon. We are very blessed. Can you say blessed anymore? I don't know. We're at Fordham. I guess the Jesuits will give us a pass. We are blessed to have 2 panelists who are indeed experts in this field. Donna and David are professionals who are involved with the emerging blockchain technology on a daily basis. I mean, they are players in real world application and not just the theoretic. You can find more complete bios on our panelists on our website for this event. But as a brief introduction, and please note that while Donna and David are both attorneys, this panel is for information only. It's not to be construed as investment advice. And with 2 attorneys on the panel, I don't want to find myself in a lot of hot water, so I read that. So Donna Riddell, she's an angel investor in blockchain and digital assets, and she's also adjunct professor with a focus on blockchain at Fordham. So Donna's all over this. David Otto is actually an old classmate from college. He spends most of his time these days with Counterpoint Ventures, which he founded, and he's a general partner of Counterpoint Sports Group, a company dedicated to tokenizing interest in professional sports franchises. So as you can see from those descriptions, our panelists are hip deep in current things going on with blockchain. The formal title to this panel is How You Benefit from the Convergence of Real Estate Investing in Blockchain Technology. And I'm a big believer in truth in advertising. So when I'm involved with a panel, I really work to stay on topic. Now, many who have dialed in today are aware that blockchain's involvement with cryptocurrencies like Bitcoin have grabbed most of the headlines. But in the reality, that's a very small part of the potential of this technology. There is some crossover, of course. We're seeing some landlords like KPG and WeWork experiment with accepting cryptocurrency as rent payments. But the bulk of this panel will focus on other uses of blockchain technology regarding real assets. Now, one of my favorite professors at HBS was Richard Tedlow, and he had a practice starting every class with a joke. And believe me, some of them weren't great. So I asked him one day, Professor, why the joke? And he said, well, Dan, if you tell a joke, you'll have their attention, and you'll have their attention for the duration because they're waiting for the next joke. So I'm not sure it was true or not, but borrowing from that strategy, here's my humble attempt. All right, so a Fordham undergrad shows her dad her work on Bitcoin's potential to speed up transactions. And in response, her father, who's a big-time capital markets guy in New York City, he asks, "You want to hear my opinion on Bitcoin?" To which his daughter replies, "Yes, of course, Dad." "It's worthless," his father says. I know, she replies, "but I want to hear it anyway." All right, I hear the groaning. Cut me some slack.
That's good.
This is a new field. It's so esoteric. There's not a lot of material to work with. It's kind of like telling medical device jokes, but hopefully this sets the tone for a fun, informative session. Let's move on to our esteemed panelists, Donna and David. Donna, if we can, let's start with you. Describe, please, for our audience, as best you can in layman's terms, what is blockchain technology?
So one correction, I'm actually not a lawyer. I did go to Fordham Law School, but I never wanted to be a lawyer. So blockchain technology is a distributed ledger. And it can be with permission or it can be permissionless. Permissionless meaning that it's not centralized and many people can verify the transactions. And so really what it does is it creates an end-to-end record that is transparent and is unchangeable. It cannot be changed once it has been put in the blockchain, and you build continually on that blockchain. And for example, and I'm sure that David can improve upon this example, if I sell him a piece of real estate and we put that transaction on the blockchain and the details about it, in 2 years from now, I can't say I didn't do it. Because it will be in there. And then if David in turn sells that piece of real estate to Daniel in a year's time and puts it in the blockchain, we now have 2 transactions related to that piece of real estate on the blockchain. And we could go in later about the kind of details we could put in there in order to be able to create more transparency, liquidity, and ease of transfer.
So what is tokenization in this spectrum of blockchain?
So I think what we can just think of tokenization as, because everybody agrees that when we're talking real estate, we're in the world of securities. We'll just consider it to be assets that can move digitally. Instead of having to have all these pieces of paper, in the same way we have email that moves information digitally, we're going to have assets, and the realization and tokenization just encompasses all the details of that asset, or a portion of it could just be cash flows, into a token, which is just a digital representation of something. The something is what we put in the details.
Yeah, Dan, let me add a little bit here without breaking your rhythm too much. It's important to, and coming on the heels of that joke, it's important to distinguish between the currency side of the asset that gets transferred on the blockchain and the asset side, digital asset side. When we're talking about digital assets, we're talking about real estate, we're talking about digital assets. we're talking about, as Donna says, these are securities. And we don't need to get into the depth, in the weeds of how the SEC determines whether or not you're selling a security versus a currency versus a utility. But that's, that's part of the backdrop. The point is that currencies operate very differently from the digital asset, security token arena. We are in the security token arena. We're dealing with digital assets, and we're dealing with the digital representation of a quantum of value in a real world asset. The real world asset in this case being the real estate. And that exercise, the identification, the creation, the fractionalization, if you will, of that asset, and then the trading of that asset is a different matter because it comes with a number of things, including smart contract capabilities that enable you to identify, customize, which you don't do with currency.
Yes, and just, we're never going to give Daniel a chance, but just to continue on the terminology and unbundling it, some of it, so it means something. This could be on the actual real estate, or it could be a limited partnership. And so we've seen tokenization starting to happen, not only in real estate limited partnerships, we started to see it in venture capital, in private equity funds, et cetera. And that enables the fund to sell smaller portions of it to persons along the way, or to entities or family offices that might have been precluded from buying the one big tranche that was offered at the onset, thereby giving liquidity along the way to the asset class.
So liquidity seems to be the big benefit here. Can't we just get liquidity by allowing limited partners or members of LLCs to sell their rights freely? Why do we need blockchain? Why do we need tokenization?
Well, you don't need it, just like we didn't need the PC to replace the typewriter. But it's a higher, more secure, more fluid, more transparent mechanism for distribution, transfer of interest, and the recording of those transfers, and the transparency around the value proposition. In other words, what's the market value of that transferred or transacted interest in that asset at a 10% stake, a 50 or 100%. So there's immediate transparency, there's immediate transfer, there's a considerable amount of cost savings on the administrative side associated with the transfer. Now, that transfer of interest in real estate isn't as fluid as the NYSE transfer, for example. That infrastructure that constitutes the trading and pricing of tokens attached to or representing a quantum of value in a real estate asset, 1%, 1/100th of 1%, 10%, that's in the process of evolving as we speak. It's a significant need and a significant part of the market, that is the alternative trading systems that are being born out of this exercise. But it's the mechanism on a blockchain protocol and the ability to transact immediately at low cost with transparency and cryptographically secure is meaningful. It's a very different exercise than simply allowing LPs to push their units into a private market. But I want to go back to the other thing that Donna touched on, and I think it's where you start, sort of the foundation of what this is all about in the real estate market. Real estate assets, commercial, residential, tend to be high value, tend to be somewhat cost prohibitive from a small investor standpoint. What tokenization can do, and this sort of dovetails with this whole LP existing system, which is somewhat exclusive and difficult to enter at the grassroots level. It will enable democratizing access to an asset class, commercial real estate and residential, that heretofore has been unavailable to an investor class, the small investors. Do you need to be accredited? Sure. But you don't know what there are instances where you would not need to be accredited, because again, the security token, the tokenization of a real estate asset is a security token. So the exemption from registration are the same as they would be, at least in this country, for any security. So you need to look at some regulatory exemptions, Reg D, Reg A, Reg A plus, and the like.
Well, let's back up. So
yeah, can I just sorry, I don't mean to interrupt you, Daniel, but I just want to continue on this thread here, because I think the example that you gave as to, we could just do it with limited partners and we could open it up now. We can still send letters, but we all send emails. And I think that this is what we're seeing now over the last, let's just say 3 to 4 years, is the increasing utilization of marketplaces to create digital assets. And so assets will be valued and transferred much more in real time. And so though it may not be at this exact moment necessary for real estate, ultimately real estate will get there. It will have many different ways in which it gets there. A limited partnership tokenization will look different than a cash flow tokenization, but it will be there. And to even extrapolate on it further, for both the institutional investor and for the individual investor, real estate will then become something that can be held in their portfolios as shares, as an asset class. And it's not lost on me and maybe on others that know a little bit about this field, that when Fidelity named their division, it's called Fidelity Digital Assets. And we can imagine in the future that you will be able to keep your digital real estate tokens in your Fidelity account and use them as part of your overall portfolio in ways that you had not heretofore been able to do. So I'll stop there, and sorry to have interrupted.
No, that clarity is great. Thanks, Donna. So you actually touched on something that's I'm struggling with, because yes, this is supposed to create liquidity, but you only have liquidity if there's an exchange. And there seem to be so many exchanges out there, none of which have risen to a prominence that creates the liquidity that you're kind of bargaining for. So what needs to happen to get us there so that you really have the liquidity?
I'll start, and then maybe David wants to add on. Okay, because we are certain that this is a security, for the most part, we'll say that this is going to trade on regulated securities exchanges. And there's been a lot of trading in tokens that are very liquid, that probably are securities, but the SEC is a little bit too busy in this area to jump in at the onset here. So normally what we'll see is alternative trading systems, ATSs, start sprouting up. Now, as we know, real estate isn't going to trade like crazy, like GameStop or something else, nor do we necessarily want it to trade like that. We'd like it to be apportioned in portfolios. So the whole notion of liquidity is a little bit more like secondary markets for venture capital, for private equity. And those exist now. So that's coming. The other thing, and we can talk about this a little bit later, is there is already starting to be in the decentralized finance world, which is not regulated, the utilization of real estate tokens and other security tokens as collateral for lending. And that's happening, it's just in its infancy now, but this will be a very serious contender for the capital markets and become a part of the capital markets in the not so distant future. And that market has ballooned in the last year.
Fascinating.
Yeah, and Dan, so add to that liquidity, following on to your question relative to liquidity. Yeah, it's true. There isn't as robust a market for the trading of real estate backed tokens or digital assets in general. but it is developing. It is coming. And the important point here is in a tokenized world, as opposed relative to financing a real estate project, whether it's the debt, equity, both, or some coupon on it, you have the ability to secure liquidity. You have the ability to move out of that. You're not trapped in it. I can't remember who it was, law professor at Fordham University once told me the coldest place on this planet is to be a minority shareholder in a privately held asset. You have no power and no liquidity. And so the liquidity enables you, in the event you have no power, to say, time's up. And
let's switch gears here a bit. Let's talk about blockchain itself. And one of the things we're hearing is there's a new push to apply this technology to contracts themselves, and these contracts are being called smart contracts, smart contracts, as we say in Boston. Dave, what are smart contracts, and what role do they play in tokenization, if any?
Oh yeah, no, it's a big role. I mean, there are some people who believe that the smart contract is a misnomer because they're neither smart nor they're contracts. But that aside, it's the computer code that is created, drafted, and applied to that particular asset class. So the smart contract is the automatic execution of the design of the security. So if the security issues a dividend every quarter, if it's a set coupon, if it's variable based on certain rules, if there's a holding period, if the security cannot transfer into other certain jurisdictions, if there's any specific date relative to distribution, all the rules and the characteristics that define the token, the asset, and your pro rata interest in the asset, meaning the token, and its relationship to the real estate, those are developed, designed via smart contract, via code, and it's a little dance between the legal description, which is very important, and the confirmation that the legal description relative to those rules around that security backed by the real estate are codified in the code that drive and animate the token. So the smart contract are the defining characteristics and value to that token.
So Donna, we're hearing that these smart contracts are going to disintermediate a lot of players in the market today. Can you speak to that for a moment?
I'm not so sure that they're going to disintermediate players. I think that players are going to have more refined and defined roles. I mean, the smart contract embodies the details of whatever details David was just talking about. Let's just take an example, which is the distribution of a dividend. You still are going to have, and this is happening now, I think on the Aspen real estate deal, the distributions of dividends are already happening. That will happen by the transfer agent, which has these digital securities listed with them, and it automatically goes into the whitelisted wallet of the holder of the security. And so it's there. And so it's not, nobody is really disintermediated, it just happens faster. And you don't have to go and look for where is my dividend, where did it hit my account, and otherwise it's like in your wallet, and you just look at it and then do what you want with your money. I think that people will be smarter, and the different intermediaries in between will be smarter as well, because some of the functionality that they're assigned to do is kind of, just been codified for so long, it doesn't really do anything. It clogs up the process. Do you need to, or, maybe title is one that will be faster. Do you need to every single time we change hands in a real estate, waste a lot of time? We could still pay the fees, but it could be done very quickly. And maybe then over time, the transaction fees will come down, which will make the whole process more seamless and cut out some of the like not the disintermediation, but the bloat in the time horizon.
Thank you, David. I'm listening. Donna's comments were very germane. The you know, when she touched on title, and obviously by extension, that's the registries. They seem to be groups that could benefit from blockchain because everybody wants clean title, and there it is. And I've been thinking about what needs to happen for this technology to be accepted widely. It would seem to me that you're going to need a very large player like the government, the counties or whoever runs the registries, to accept it. And what it's going to take until then for this to be widely applied in the real estate sector. No, am I missing it?
Okay. No, I'm not sure. I'm not sure I agree. I'm not sure that governments are the sort of at the vanguard of innovation and early adoption. For example, if you look at Bitcoin, was it El Salvador? It's the first government to adopt that. But Bitcoin as a market cap is what, the 9th or 10th largest asset in the world. So the adoption issue, and that's fundamentally, my view, where we are going. It's the decentralization of access and distribution of value. You don't need governments. The banks, for example, have completely missed the whole crypto evolution. Banks are natural sites for onboarding crypto wallet holders and parties that want to be involved in cryptocurrency. Name one bank that's done it. Generally, they stayed away from it. They're not early adopters, and governments definitely are not early. And the government, in my view, they are not going to create a government blockchain. It's going to be an adoption of something that's already out there, something that's already existed. So widespread adoption, it's not top down, it's bottom up. Bottom up is parties that are already doing the creations, are already adopting currencies, are already creating digital securities, that are comfortable with technology, that view the technology, understand the technology to be more secure, more readily available, more accessible, and therefore an improvement from current to past processes. So I don't see. Now, having said that, relative to government, regulatory clarity is a big issue. Regulatory, where the SEC stands, where Treasury stands, where government stands on the development and refinement, trading, and creation of digital assets and digital currency, which is an adjacent topic, is a very, very important issue right now. Now, for the assets we're talking about here, digital securities and real estate, it's pretty clear. We're operating in the securities law.
Yeah, and just let me use two examples of where something happens relatively quickly when there's a little bit of a hiccup in the system. And I mentioned GameStop before. Well, GameStop happened, and people learned about how the Depository Trust Corporation works with stocks. And all of a sudden, the DTCC, which had been treading its feet, let's say, heavily on implementing a blockchain-based securities system, is out in the forefront of wanting to do that. Why? Because they were caught not being able to reconcile who owes what in a world of T+2, 2-day settlement, when everything else is settling in and around them, very, very, very quickly. So that's one quasi-governmental agency, I would say, because it has the implicit support of the SEC. So that was one of them. The other big behemoth that we have implementing now blockchain technology is SWIFT. Everybody uses SWIFT for wire transfers. But we're seeing that you could do payment on blockchain rails much faster than SWIFT. If I'm in the US and I do a wire transfer on Friday morning to, let's say, Japan, I'm not going to know that that was settled until Monday. And so, and that's Monday when it's my time and I wake up. Whereas in a blockchain-based world with any kinds of crypto or tokens, you can know almost immediately what's going on. So these changes happen because the world around us looks for more immediate liquidity and settlement because we operate in that kind of a world as it is now.
David, where does the U.S. stand in its advancement in this space? Are the Western powers leading? Is Europe ahead of the U.S.? Is Asia in front of this?
Well, sort of as an aside, we're looking at tokenizing a Counterpoint Sports Group, tokenizing an interest in a pro sports basketball team in Europe. Interestingly, it seems that the regulatory side on the ICO, initial coin offering, the sort of random coin that goes out there as a currency with no real value proposition, is a bit looser than it is in the US. Conversely, the notion of a security token, the type of security we would use for tokenizing interest in real estate, is much more developed in the US. Now, Switzerland has a model that's fairly well developed and interesting from a coin standpoint, a utility standpoint, and a security standpoint, which tend to be the sort of three pillars. But the U.S. is an economic engine of the world, and that the regulatory uncertainty and the need for clarity and the need to adopt progressive reform around digital assets and digital currencies is a need. We need it now. We've needed it for a couple of years, and the Chinese have got the digital yuan in circulation already. We're talking about the USDC, U.S. digital currency, central bank digital currency. There's a lot of talk, and I'm not sure central bank digital currency is the way to go anyway. So where are we? We've basically shoved the tokenization exercise or asset-backed exercise for tokenization, securities on the blockchain, into the securities regulation sort of oversight and review. And I'm not sure that's appropriate either, but that's a whole other question. For all the lawyers out there, you're familiar with the Howey test, H-O-W-Y, and I essentially believe that the SEC is making a mistake when they're comparing the asset, the token, or the currency to the investment contract. It's much like comparing it to the fruit.
Yeah, well, I'm sure those questions need to be answered.
Daniel, on the answer to that, I would just say, a great security token regime has been developed comprehensively in Bermuda and also Liechtenstein. Smaller countries, very regulatory oriented. I mean, Bermuda, as we all know, has great reinsurance. They're not going to in any way dampen their regulatory framework in order to do some kind of crazy token thing. Same thing with Liechtenstein. Wyoming, if you take Wyoming in our country, they created a whole crypto set of rules that goes from the UCC filing all the way through the banking system. And they could do these different countries could do these things in a way because they don't have many legacy interests there that are in any way saying, wait, maybe I'm going to be in some way disadvantaged going forward. In fact, they won't be. And for even you see in the past, it's very possible for a country or a state to take a lot of business in something that's going to be the future if they put together a really good regulatory regime. We saw that Delaware long ago. It was New Jersey that had the registration of all of the corporations. Delaware said, we can do this. And where Delaware now is the place in which you register. Wyoming hopes to be the place in which you custody your crypto assets. And I think that both Bermuda, Liechtenstein, and others that are doing whole regulatory frameworks for securities and crypto assets are really smart.
It's interesting, thinking about an emerging technology or a way of doing business, you think back to some of the ones that have happened over the years, and two things come to mind for me is that, one, they can often take decades to be adopted, like the internet. And then another way of doing business, these tenants in common ownership that were popular, 15, 20 years ago, you had a lot of bad actors getting involved, and it really tarnished an otherwise, okay way to do business. So those are maybe some of the roadblocks, or rather road bumps, speed bumps that blockchain may face being adopted widely. David, any comments there?
On the wide adoption of blockchain?
Yeah.
It's already widely adopted. It is global, it's 24/7. You've got what? Top 4 currencies, BTC, ETH, Tether, and Cardano, that make up, close to $1 trillion in market cap.
Have there been any lawsuits on bad actors abusing it?
Abusing the currency? Well, the whole ICO thing that happened in 2017, oh yeah, there have been lawsuits, but those lawsuits have focused on either what you're selling doesn't do what you say it does, so it's a fraud, or what you're selling is a security, and you didn't seek proper exemption from registration or register it. The Telegram lawsuit's a big one. So yeah, there have been lawsuits. Yeah. They've been around that whole issue of regulatory uncertainty. By the way, it's not clear how, say, a currency like Ethereum or ETH, how that moved from its initial issuance, it looked like a security, to a currency. There's no clarity from a regulatory standpoint how that happened. It was just declared. So the process by which you can either evolve, I get that the standard is your currency has to be sufficiently decentralized. That's the term the SEC used to say ETH is not a security, it's a currency. But beyond that, the initial distribution of these isn't clear that if you put the sort of test that's applied now and has been applied, again, the Howey test, that it wouldn't have been a security from the outset.
Yeah, I get that there's still some focus trying to get the regulatory side squared away. I was more curious that we're seeing challenges to our economy and energy and food processing with bad actors. I didn't know if that had manifested itself in this space. Donna, do you have a comment?
Yeah, no, I think that, look, this whole area is one big startup, okay? And there are many, many startups within it. And I think anybody that's reasonable, you can be excited about the technology, you can be excited about the individual company, but you have to apply the same kind of due diligence that you do to anything else. Just because I say to David, hey, David, I think this is really fantastic, doesn't mean he should jump tomorrow, sell his car and put the money of the car into that thing. He's got to do the same thing he would do with any other investment or any other new technology. He's got to do his due diligence. He has to look at who's selling this, how are they selling it, what are the promises they make, what does the white paper look like, etc. There's anybody that thinks money is a fast thing to make, you got to go back and go to your principles of how do you look at it, any investment. So I think that was is always some of what's going on in new technologies, because your friend made a lot of money in X, Y is coming around, you say, I don't want to miss out. FOMO ends you up in a bad story. You have to always go back to your investment principles. So I think that, the headlines that you get for some of the failures are associated with people that were in the beginning not honorable, or there are some things in which some of the smart contracts, as David already said, contracts are very smart. Sometimes there's a bug in the computer code on it, and it allows for an exploit, which is why a lot of this is, in my view, like in beta testing. But that doesn't mean That doesn't really happen as much in the security token world. And also in the security token world, we don't have the same problem that you have in Bitcoin or in ETH. The token can be recreated. Even though it's on a blockchain, if for some reason you lose it or otherwise, the issuer can recreate it because it is a closed system. It's not in the same way that it is in some of these other cryptocurrencies. So I think we need to be careful when we talk about the characteristics of security tokens, because they are faster settling, they are all of those other things that we talked about, but at the same time, they do offer protections that other crypto assets don't.
Great. You know, it might be helpful for our audience if we could maybe walk through a real world example. Donnie, you mentioned the Aspen St. Regis, which got a lot of press when it was done. I understand that there have been dozens, if not, maybe even over 100 transactions done in this country, not all as prolific or as popular as that was. Are you familiar with that transaction and maybe how it came to be?
I am, but it's not my most favorite one. So I'll start with that. So Aspen is a hotel, is a city, and the Aspen, I think it's the St. Regis is a hotel there. They were going to do a single property REIT, and instead did a tokenization. They did not tokenize the real estate per se. They tokenized a portion of what would look a little bit like a fund. So you did not get the real estate, but you got the right to a certain percentage of the cash flow relating to that real estate. And they sold about, I want to say 20% of the entire, let's say, fund, which represented the asset. They have since then, it's trades, and the money gets distributed as it is not from the trading, but from the cash flow, gets distributed to the holders of the security tokens. There are other ones that, the US has not done as many, going back to jurisdictions. Germany seems to be quite popular in doing these, also because they have exchanges in which you can now trade securities tokens. David already mentioned Switzerland as a jurisdiction in which you can do it. Abbey Rosen, who I'm sure you all know the name of, he sold 30% of the Chrysler building to a German fund, and that is tokenized. And so you're seeing more of these transactions happen. I don't know, I don't follow all of the trading that happens thereafter, but I've not heard any bad news stories on any of them that are, are the bigger transactions that are going forward.
Yeah, just to echo Donna's comments, Dan, the majority of the action is around tokenizing, say, an existing piece of debt, or bringing more equity via tokenization to the table. It isn't taking the real estate and transferring that out of its existing sort of documented infrastructure. It's looking at a way to bring other capital in via a debt or equity sort of infusion, and the tokenization exercise addresses that security.
So
I want to just bring in one other terminology, and maybe David can elaborate on it. There are things called non-fungible tokens, which are called NFTs. Non-fungible tokens can immortalize something. They can immortalize a title. They can immortalize, many of us hear about it now because of art. A piece of art was sold at Christie's for $69 million. But NFTs as something that can be collateralized and can be immortalized, even at whether it's the asset, the title, or otherwise, is something that's going to be very big for real estate. And it's a different thing than a security token. It is the visualization of something that is an asset or is a property of an asset. Maybe David wants to go on a little bit about that.
Yeah, the NFT world has been sort of inundated with the digital representation of an asset. I think Novogratz dropped some money in a virtual real estate deal recently. I don't know that I'd be sort of mucking around the virtual real estate market when there's so much actual real estate that can benefit from this technology. I mean, the global real estate market is what, 200 trillion or more? And the vast majority of that hasn't benefited an ounce or hasn't sought to benefit an ounce from the blockchain, tokenization, liquidity, distribution, reduced administrative costs and the like. So yeah, the NFT business is significant, but you've got to be, I think you've got to be mindful of where the opportunities are and what, I'm not sure that a digital asset like a virtual home, I just don't know where the value proposition.
No, I wasn't only meaning in the virtual world. I was meaning that I could create an NFT of my title.
Sure. Oh, yeah, yeah.
To my house, to my apartment, and put it on the blockchain. And then that could be sold along with or included with any sale. So there it is on the blockchain as an NFT, and it goes along. I was yes, though I do know about the kind of virtual world, which is to me a little bit like Second Life. But yes, yeah. No,
okay.
The world assets that you can then immortalize as non-fungible tokens.
Exactly, and that's the point I was trying to make. Obviously, I wasn't clear enough. Is that the NFT business thus far has been getting a lot of color relative to the virtual world, when in fact the NFT value proposition, in my view, and I think yours, Donna, has much more to do with real world assets.
You know, one of the other areas I was thinking that might be a challenge for adoption of blockchain. Dave, you mentioned you're involved with trying to tokenize a sports franchise in Europe. You know, thinking about this country and where most, if not all, except for the Packers, are private. And so being private, it's, you know, the ownership today of these entities may like that, may prefer that it's private and no one really knows what the valuation is, what they're putting on their balance sheet and what they're telling their bankers. Or once you tokenize something, and even if it's a small fraction, like Donna said, only 20% of the hotel. Now, real estate's a little different because you can do comps on other properties, but sports franchises, they're pretty dissimilar. And to see now somebody who had something that was private, its valuation was private, and all of a sudden overnight it's the small fractions on the blockchain, and people can see the trades and extrapolate to the valuation. Do you see that as a challenge, or it's just an education process?
I see it as a great thing. I see it as a good thing. By the way, the Packers are not publicly owned. Those are just certificates that you were sold, in effect, for your money that allow you to vote on something that really doesn't matter. They don't own the asset.
They can trade those interests, though, I believe.
Well, I'm sure they can, but all you're trading is a certificate that you put money up to help remodel the stadium. Back to the pro sports franchise model. So in pro sports, there are essentially two creators of value. The people that are on the field or on the court. And this goes to this whole issue with the NCAA too, by the way, but I won't get into that. That'll be a different presentation by the Fordham group. There are two creators of value: people on the court and on the field, and the people in the stand. People who buy the tickets, watch the team, buy the hats, the t-shirts. So those two constituencies are significant. And without them, there's no pro sports franchise. Yet, neither constituency, for the most part, has any stake whatsoever in the asset, the team. Why? It's a legacy product of 20th century capitalism. So, what you can do with tokenization and where the opportunity lies, think about it here. A team wants to, and we're looking at this for Seattle because we lost our NBA team a while ago. A team wants to or a group wants to bring a team to a location, or a team wants to tokenize some part of that that asset, 10%, 20%, or buy a team. The tokenization exercise now gets a distribution model, has a distribution model with respect to both the fan base. Fans now have an economic interest in that team. It isn't just buying a burger and tickets and the hat and the sweatshirt, but you're helping promote a community asset. You are invested in a community asset, and you have the ability, should you wish to get out of that investment. So and then on the player side, that's a longer discussion, but it's long overdue. And I think we're starting to see the tip of the iceberg with respect to compensation of NCAA athletes. They're the value creators. So that's where we're starting to go relative to pro sports franchises. Does the current ownership or the current league want to do this? No. They've made it clear that they like. In fact, we met with the NBA, and the quote was, "We look at our teams as Picasso, and we kind of like the private access and ownership of that Picasso." On the other hand, when we explained to a group representing the New York Yankees that via tokenization, rather than one guy writing a $200 million check for an interest in the asset, what about 200 people writing $1 million checks for an interest in an asset? And they got the value proposition.
Yeah,
That's fascinating.
And there's so many other kinds of tokens. You're talking about an equity interest participation token, but we saw in the marketplace Top Shot, which created moments of NBA sports that they monetized. They monetized this entire portfolio just at the beginning, monetized the portfolio of moments, meaning shots, just shots like that. And in the first quarter of existence, they sold almost 300 million of these Top Shots. And so, you're going to have an explosion of the way in which fans can connect with their favorite team, their favorite player. And then within these tokens, you can have other kinds of tokens that are social tokens, whereby if I buy 5 moments, I get the right to get an autograph from Michael Jordan or something else. I go to the club and I have a lot of social tokens because I bought a lot of stuff, or I participated or shown my fan exuberance. And when I go to see the Yankees, they let me go and shake a hand with one of the catchers there or something. So there's going to be the development through these tokens, whether they be security tokens or otherwise, ways in which you can participate in a world in which you were a voyeur, but now your voyeurism actually you can get some rewards for.
That's fascinating. It seems that this blockchain technology has applications for trade finance, for medical, for elections. I mean, the list goes on and on. And time permitting here, boy, it would be great to get into all of that. I think it's helpful for the audience to see that this isn't just a real estate change that is potentially coming. But getting back to our audience, which is dominated by real estate folks, perhaps if someone's considering a tokenization strategy, what might that include, David?
Well, the strategy side has a lot to do with what's your objective, what's your goal, where are you looking to go? Are you looking to sell equity? Are you looking to raise debt? Are you looking to create a coupon? Your strategy that has to do with what assets? Is it a portion of the asset? Is that portion easily segregated from your portfolio? The token holder base. how broad, widely defined do you want that base? Do you want it domestic? Do you want it international? What are the regulatory implications for that? So there's this concept, AML, anti-money laundering, KYC, know your customer. That AML KYC exercise, it has to be robust and understandable from both the issuer standpoint and the parties that are coming in. You can't just sell tokens to some multi-millionaire out of North Korea, for example. So the strategic issues around the asset, the features and functionality, the smart contract associated with the asset, where it's going, and confirming the smart contract characteristics of the asset are codified in the code, and that all that strategic sort of thinking and application is really important to ensure that what you're looking to do, you actually are going to be able to accomplish.
Yeah, and to interrupt here, we're getting close to the end, and we have a lot of great questions. Can we take some questions from the audience?
Can I just point out one thing? It's to show the audience, and then we can answer any other questions, that this is happening every day. I just got an email that BNP Capital Group announces the first blockchain-based commercial mortgage executed in Miami's iconic Brickell district. So this is happening all around real estate. And as Daniel pointed out, it's also happening everywhere else. I mean, supply chain, especially post-COVID, is really a hot area for blockchain. But Andy, why don't you, I'll stop talking.
Can I just add, I just add one more thing, some broad thematic, because this is, and this underscores Don's point. This is happening, and it's the parallel, I know you hear it a lot, is the internet. Well, the internet gave us what? Ultimately, immediate, free, widespread access to information. What blockchain is giving us is immediate, widespread, secure ability to transfer value. And it isn't a debate. It's going to happen. You're either on board or it's going to blow right past you. But that's what we're doing. That's what we're dealing with. And that's how we're dealing with it.
Thank you. This has been fascinating. I apologize to the audience. We were going to go to questions a little earlier, but candidly, our panelists are so interesting. I wanted to keep them rolling. I understand Fordham's going to allow us some more time. So if you can hang out, I know we said this was going to end at 1 Eastern time, but we can hang out. Our panelists have agreed to hang out. And so we'll do that. Andy Maris, who's Associate Dean at Fordham, has been reviewing the questions. And Andy, maybe you can introduce some of these.
Sure, there were a lot of really great questions and a lot of similar questions. Some were about how the blockchain is about the decentralization in a real estate transaction. And a few people asked, do you think we can get to a place where it will be a peer-to-peer transaction? And someone else asked about a wallet-to-wallet transaction, keeping the banks and legal fees out of the deal. And then could this transaction occur using cryptocurrency? And is this possible with the technology that's available today?
So are we ready? I mean, we can separate this into two different parts. One is, I mean, as long as somebody is willing to accept crypto, you can accept crypto. There's no limitation doing that. There have been a number of different, widely noted purchases done in crypto. In and around real estate. Sotheby's is accepting, I think it's Sotheby's, crypto for a huge diamond that they're selling. So that's no different than real estate. And peer-to-peer, well, yes, you'll be able to do it peer-to-peer, but since it's a security, it still has to be listed somewhere. So there will be a centralized area for securities in which it's going to be listed, and that will be through either a transfer agent or other ways in which to list it. But David may know more specifically about how that's going to be handled.
Okay, great. And another question, at a very basic level, how do tokens provide additional transparency from, say, a title report on a real estate asset? For example, do tokens require disclosure of beneficiaries of owner entities?
They sure can. Again, the programmability or the content of the token is a function of what you program into it, and then retain the ability to modify. Donna's point earlier around tokens having many capabilities and offering other benefits or other attributes. That's the flexible and programmable part of the token. It's code, and as long as you continue to access it, it has that ability to be modified. So yeah, the entire title, the infrastructure and content is very readily transformable into a blockchain enabled, accessible and distributed infrastructure. I mean, it's pretty ideal actually. Now, the question is moving all that paper content into a digital form. But that was the exercise the music industry went through a few years ago. Is,
right.
Moving that content into a digital form.
Yep. I think this is a related question. Are digital real estate tokens public, and is there an opportunity for money laundering for people seeking to hide money movements?
I think, I don't know what you mean by public. It will be, they're all whitelisted. And so when you get whitelisted, normally that means you have to do KYC AML. So, if you're going to buy, if I'm going to buy a token from David, he's going to have to know either who I am or who the entity is. And it's up to him to decide how much disclosure he wants to do in that. I mean, so I think it will be completely compliant with whatever the rules and regulations are now. And so to the extent that somebody buys an apartment in New York and they hide who they are, I don't know if that's, I'm just me. I don't buy apartments in New York except for mine. I don't know whether that's feasible or not to do anymore, to hide behind an LLC. But in the real estate token world, you will do exactly what is compliant with the law. And so you're not going to be able to just, go and make up new rules.
Yeah, there's been a lot of press around sort of dark money and that whole attempt at staying under the radar. That's not what this is about at all. In fact, being able to track owner access to the asset class of security token or real estate backed token is eminently more plausible with a blockchain protocol than it is in a sort of traditional structure. And remember, as Donna says, you're not just able to come into it if you want. There's a regime: anti-money laundering, AML, and KYC. Know your customer. So it's a compliance exercise, and banks are very familiar with it. As I said earlier, banks are a pretty natural place for onboarding. They just didn't see it, and they're money transmitters. They just didn't want to take it on for whatever reason.
And just to show a point, the whitelisted wallets, the smart contract can know that this token cannot be sold to, let's just say, a non-US resident. So some tokens, and the opposite, some tokens cannot go to US residents, or they can only go to persons that are accredited investors. You can put that all in the smart contract, and then the token can't transfer because that wallet is not whitelisted or accredited for those standards.
Yeah, in fact, AML standards are derived in part based on countries that the United States says we cannot do business with. So you cannot sell those tokens into that country for various reasons. So there are mechanisms in place for ensuring that this isn't just a big dark money exercise.
There were some questions about smart contracts. Are smart contracts required to tokenize deeds, given that deeds have things like life estates, remainders, and reversions? Has anyone created a third-party index for those smart contracts that links to things like vital records?
Well, on the vital records, I don't know, but the smart contract execution relative to deeds, I mean, that would be the content of the smart contract. So to the extent you wanted to sell a token that had that information, then you're incorporating that into the token. Can you issue a token that has no content? Yeah, but it starts to look a little bit more like a currency. And then the question is, what's it backed by? So, but remember, you can issue a token that's not an economic interest. It can be an informational asset. So I'm not sure if that was the question, but there's a number of ways to do it, to use the technology.
Okay. Another question. While I have a basic understanding about the fractional ownership of real estate assets through tokens, I'm quite confused how that will translate in the operational expenses of said asset. Could you please touch on that?
It would be, so if a regular interest was $1 million, let's just say, and $1 million, the fees associated with that were 2%. We'll just make it up, 2% annually. If you break that into 10 pieces, in theory, it would be 2% divided by 10. There might be some infinitesimal amount at the onset that you might have to charge for the tokenization, but then on a yearly basis, it shouldn't cost almost anything to just.
Well, you have to pay for the registration every year. Doesn't the sponsors have that load?
Oh, I don't know. That's more real estate than I know.
No, the registration of the token. So it has to be on an exchange, right?
No, it doesn't have to be on an exchange. It can be private.
No.
So the token doesn't have to be on an exchange. So the issue, so before you could decide that this is, we're gonna take our LP and we're gonna tokenize it, and then that means that I don't have to go back to Daniel, who's the operating partner, every single time. I can get Andy's wallet whitelisted so that he knows now who she is. And she complies with the requirements as an investor, and she's a U.S. person. She's over 18 or whatever else the requirements are. And then I can I can sell her my portion, which means that I'm not stuck with Daniel anymore if I don't want to be, which takes us back to the beginning of the conversation that I think it was Daniel talked about in these limited partnerships and the role of the operating partner, and that I have no liquidity. Andy might be willing to take my share in this limited partnership for only a 20% discount, whereas before, if I wanted to get out, I'm stuck because Daniel's going to offer me like 60 cents on the dollar, and he's going to say take it or leave it because I'm the only way out, which I think would make real estate much more attractive. I mean, the limited partnership structure, I understand where it's protected, et cetera, but it also creates such limited liquidity for people that it's not something I would ever recommend as a way.
Excellent.
Some general questions. Where does one find a real estate smart contract template, and how are they structured, and where will the tokens be traded? Two separate questions.
Where do you find a template for a smart contract?
Yeah.
Well, they're not just popping up online. Without being too promotional, you need to work with people who do this, both on the legal side and the tech side. There are platforms that offer advice and can help structure the token, no question. So you'd want to engage them. We're working with, I'm not promoting anybody here, but Securitize we work with, and they're a very, very capable organization. But that getting into how to design these You don't want to try to do that sort of one-off, on your own. You've got to have some level of experience, both on the legal side and on the tech side.
Quick question. Why would someone, I think this is for Donna, why would someone favor tokens over REIT shares?
I think that tokens are going to be more widely used, and they will settle more quickly, and you'll be able to transact more easily in them. A REIT share, for the most part, is going to have to be sold on an exchange, and it depends if you're talking, the question is from the vantage point of an investor or from the vantage point of a person who's going to be creating the REIT. From what I understand, I don't create REITs or anything. The REIT structures is quite expensive, and the annual maintenance for SEC registration of that structure is very expensive as well. And so over time, people will prefer the token structure, both as someone who is creating the entity as well as someone who's buying it. But David probably knows more on that.
Well, just even from just an investment perspective, having run a public REIT, these stocks over time, they reflect the overall market, whereas tokenizing real estate, you're really getting an ownership interest in private equity real estate, which actually tends to be a pretty good complement to a securities portfolio. So it's a very different investment than a public security.
Great. Another question, by the way, I will put our panelists' email addresses in the chat. So if you have questions directly for them, you can ask them directly. And we also have a recording of this, which we'll send to everyone. We've gotten some notes that people have to jump off, but want to watch it later. So another question, how does tokenization account for things like quit claims and adverse possession? Is there a third-party intermediary that has the power to create outputs on the tokenized chain without corresponding inputs?
If the question has to do with, can you have off-chain determinations impact the on-chain sort of value or information associated with that token, the answer is yes. I'm not sure that's the question, but yeah, the ability to if the quit claim is post creation of the token and you want that memorialized in the token, absolutely. I mean, that becomes a pretty fundamental piece of the value proposition, frankly.
But so, there's a disconnect, isn't there? I mean, the registry's all by itself, and the token, there's not a direct link.
Yeah, you can create a direct link. It's called, so that's called an oracle. So the smart contract, let's say it needs to get some information. It needs to get information, I don't know, let's just say pricing, I don't know, pricing of debt or something like that. It goes to this central place, which is then called an oracle, and it feeds in the information there. So a lot of contracts, for example, there's an oracle that feeds in the prices of ETH, the currency ETH, and then that determines something. It determines the collateral or whatever else. So that's the outside thing. So yes, the smart contract in the token can talk to anything here as long as you tell it what it's talking to and what it's talking about. And then as a consequence, it can make decisions. ETH gets to 3,000, this happens. ETH gets to 2,000, Y happens.
Does the oracle have an email address or its phone number?
No. It's just in the pearly gates of somewhere.
Perhaps this should be our last question, and it's a two-parter. Tokenized real estate adds liquidity by allowing token holders to easily transfer some non-controlling equity interest in a property. This means that when the party that has controlling interest in the property sells, they're not selling equity share in the property, but rather selling their controlling interest in the property. This essentially means that there will never be a divestiture cash flow to the token unless there's a forced buyout clause in the smart contract, which should lead the token to be priced at a premium at any given time. Question number one, who should determine this premium, the controlling interest or the market?
Market. Okay. I'm not sure though if that token interest is represents a controlling interest. Then if you sell that controlling interest, you sell the token interest. You're selling the controlling interest. If we're bifurcating equity and the value of the token, whatever the token represents, some right to a distribution, for example. Yeah, I get that. So what's the question? Who determines that premium? I think it's only fair that the market can determine that. Yeah. And then the question is, well, what happens if the market decides they don't like the controlling shareholder and they want to bid the price down just in order to screw the controlling shareholder? That's not really really accommodated for.
Okay. And then the last question, how do we add transparency to the risk associated with a change in the party with controlling interest? For example, in real estate private equity firm A sells the controlling interest to real estate private equity firm B, who may affect the property in a positive or negative way by way of management or refinancing.
Well, if in fact you have, if there's, I would say it's the same answer, the market would reflect it. So, I mean, it depends how, many of these things are structured. The way they're currently structured will be different, I think, than the way in the future that they'll be structured. I think that in the future, there'll be able to be some voting amongst the token holders, or some ability for the token holders to be able to speak to one another about these changes, and therefore be able to influence perhaps the outcome or the perception of this change. Otherwise, you'll just see the liquidity dry up in as you would in anything else.
Okay. Well, I think the questions keep coming in, and if your question was not answered, feel free to reach out directly to our wonderful visionary panelists today. And I want to thank everyone, thank our panelists for all of this insight. I'm sure we could have gone on for an extra hour easily, or maybe we should have a part 2, because this was really fascinating. On behalf of the Real Estate Institute, thank you, Dan, David, Donna, and thank you everyone.
Thanks, Andy. Donna, David, great job. Thank you so much.
Yeah, Donna, thanks. Dana, well done. Thanks, Andy.
Thanks, everyone.
Thank you very much.
Okay.
Bye.
Bye-bye.